Hello, everyone. Joe Massey, your Chief Investment Officer, and it's time for another market review. So let's have some fun. Okay, I want to start off reviewing portfolio goals because we get a lot of questions about should I be in stocks or should I be in bonds, should I be in cash? And the most important thing we can remind you of is to integrate your financial plan with your investment plan. And so let's just do a quick review of your portfolio goals. So, most of the time people want to ride the bulls, right? Optimize the upside capture. And in the down markets, they're trying to tame the bears, right? Minimize the downside capture. And so in essence, people want to build better diversified portfolios. And I think what we're trying to do is take an approach of we would like portfolios that have reasonable returns, right? We don't want to be the highest all the time. We don't need to chase risk, and we definitely don't want to be the lowest. So we're looking to be reasonable in our approach to balancing risk and return. We're also looking, again, for that reasonable risk. We don't want to take such little risk that we don't get any return. And we don't want to take so much risk that we can jeopardize principal, right? It's kind of a balanced, prudent approach. And then, of course, we need to look at reasonable time periods. It's unreasonable to build a growth risk on equity portfolio and then worry about it every quarter, right? Those portfolios are meant for 3, 5, 10, and longer time periods. So it's really important to understand your time periods that you're looking at. Okay, so again, ride the bulls, tame the bears, and then build reasonable portfolios. And so when we're building a portfolio, it's kind of like building a house, right? We got to start with building your investment blueprints. The investment blueprints are what we call an investment policy statement. And if you went to a contractor and said, hey, I want you to build us a house, you wouldn't just turn the keys over and say, great, build me a house. You wouldn't know if they built you a house that you could afford. You wouldn't know if they built you a stick-built house, a brick house, a log cabin, right? You definitely would want some blueprints that an architect drew up before you handed it over to the general contractor to execute the building of your house. Okay, so that's the same thing we're going to do here. And really quickly, we basically kind of have 3 sleeves. We have the first sleeve that you can get liquid investments with some protection. And those things are like checking and savings accounts and T-bills and money markets and CDs. And these are wonderful options to have, and they're going to give you, usually a lower rate of return. Maybe, for example, in current conditions, maybe 0 to 4%. The next sleeve is, you can get some protection with some gains, and those are going to be products like structured products and index-linked accounts, annuities. And these types of accounts have ceilings and floors on them, and usually range somewhere between 0 and 6%. And then the third sleeve investments are where you get the potential for gains and you with some liquidity. And those are your stocks and your bonds and your mutual funds, ETFs, real estate, your other risk on investments. And of course, as an example, they range from maybe negative 50 to up 50. Now, of course, you can lose all your money in those as well. But just as an example, I think that a negative 50 to plus 50 range kind of gives you the idea that yes, if you're in risk on assets, because risk and return go together, if you take more risk, then you have the potential for more gains. Okay, so we just want to review those portfolio goals with you briefly. Okay, now when it comes to your final allocation of your portfolio goals, you might sit down with us, your advisors, and say, listen, I think that we would like 10% in those liquid sleeves. We'd like 45% maybe in that protected sleeve. And then I think we're able to put 45% on those risk on sleeves that can give us potential gains with some liquidity. And so we would say, great, that's your kind of your risk temperament, 10, 45, 45. But we can't just let you stop there because we are the fiduciaries, right? So what we're going to do then in the process, we are going to do a fiduciary double check. And so we're going to take your desired allocation of those sleeves, of those ABC, and we're going to compare those to what we call your unique lifestyle return benchmark. Your LRB is the rate of return that your portfolio must earn to make your financial plan come true. Okay, and so what we do is we have a 4-step process. Step number 1 is we look at your desired spending level. 2, we look at your risk willingness, your willingness to take risk, and then 3, we take your ability to take risk, and we bring those together where we translate that into your minimum absolute return requirement, which we call your LRB. So basically, on the right, if you think about it, we take your current age and the assets that you've accumulated. We look at all the cash flows in between now and your life expectancy, your time horizon. So we'll look at taxes and fees and inflation and gifts and inheritance and all the cash flows that you may have coming in and out of your life. And then we reverse engineer the return required to make that financial plan come true. And that is your LRB. Okay, so if your LRB is higher than the expected return on your allocation of your ABC, then we have to have client education, right? We have to say, well, listen, you might need to save more, spend less, retire later, but we just can't take more risk in investments and hope that it will work out. We are bound by the reality of the capital market assumptions. The capital market assumptions are the expected returns and risk in the market at any given time. Okay, so this is a dynamic and adaptive process, right? So you just don't do this once. That's why we continually bring this up in our quarterly updates. This is, number one, you have to evaluate both where you are, and then we evaluate where the economy is. Then you turn to that, determine your allocation, right? You may have that ABC allocation process. That then develops your IPS. Okay, we then measure those two, right? We make sure we do a fiduciary double check and that it's going to work, or at least on paper. And then, of course, we monitor those circumstances dynamically. So again, this process is really going to be the key to some of the things that we're going to talk about later on when we get to the geopolitical risks and what the markets are going to do and whether we're going to have a recession or not. Okay, so the portfolio can only be a part of the solution. The entire solution is integrating the financial plan with your investment plan. Okay, let's talk about cycles. So, cycles usually start off when the Fed has low rates, right? The interest rates are low, both on the 10-year Treasury and on your mortgages and the Fed funds rates. And the low rates increases growth, right? It causes growth. And that growth then turns into higher inflation. And the higher inflation turns into higher rates. And of course, that hits a peak. Once we hit the peak of the cycle, the Federal Reserve usually decides to stir the economy up again, which we'll talk about more in detail in a few slides. And so they raise rates, and then that slows the growth, lowers inflation, which leads you back to lower rates. And that's the trough, right? So that's how you go from a peak to a trough. You're increasing growth, the higher inflation, the higher rates. Then that turns into slowing growth, lower inflation, lower rates, and we start all over again. So on the left-hand side of this equation, that would be the expansion side, where the arrows are going up, right? The low rates, increasing growth, higher inflation, that's an expansionary part of the cycle. And then on the other side, the slowing growth, lower inflation, lower rates, coming back down is the recession side of the cycle. So now looking at the details here, and I know this is always an eyeful, but this is what we're looking at. So on this screen, on the top bars, we have the green bars, and these are the economic indicators that are called leading economic indicators. And this is where we're going. These are the indicators that are kind of looking into the future and seeing where it's like looking out the windshield of the car when you're driving. And these are the leading indicators. In the blue bars, these are the where we're at now indicators, right? This is, where are we right now? This is live time, okay? And those are technically called coincident indicators. And then the orange bars, those are where we've been. This is like looking out of the rear view mirror. These are the lagging indicators, okay? And then, of course, now that we've looked out the windshield, we've looked out the rear view mirror, we've looked at our side window to see where we're at, is what got us here? What road are we on? And that's usually the Fed rate cycle, and that's on the red bars, okay? So if you look at the top right end of the screen here, you'll see that the leading indicators are still down, right? And the coincidents are okay, they're positive, and the lagging have come down, so they followed the leading indicators down, but they haven't turned negative yet, right? And so the Fed has paused, and so the hope is for the soft landing, which we'll talk about, is that these leading indicators start to turn up. And if you'll notice historically that these leading indicators, there can be a lag before the recession hits. The recession are these red bars right here. Okay, so back here you can see that the leading economic indicators turned to negative well before the recession started. And we can see that back here again in the early 2000s. Okay, so again, this is what we're looking at. This is what causes the cycle. And if you think of the cycle, you can see here rates were high, then the Fed brings them down, then rates go high, then they go low, then they kept them low in this long expansionary period after the great financial crisis. And then they cycled back up, they cycled back down, and so this is the cycle that we showed you on the slide prior. And so what's driving a market cycle? From watching these videos, you guys already know, great and well-informed investors, inflation, interest rates, corporate earnings, the Fed, and geopolitical events are the 5 factors that are really predominantly affecting the market cycle. And we'll talk more about these in detail later. But for now, inflation's coming down, so that's good. But there is concern that it may tick back up. Okay, so I don't think we're out of the woods yet, but it has definitely been coming down. Interest rates have a slight rise, and so there's been a little flight to quality here recently with the geopolitical issues. And so when rates go up, bond prices go down. So bonds have struggled a little bit this year because of that flight to quality and the rising rates. Corporate earnings have been pretty resilient. The Fed has paused, which is nice. It's expected to come down. And again, we'll talk more about that a little bit later on. But in general, the market came into the year expecting maybe 5 or 6 rate cuts. Now they're hoping for maybe 1 or 2. And so if the market doesn't get their sugar high, if they don't get their rate cuts, we could see the markets pull back. It doesn't have to, because I'm not sure we really need rate cuts yet. But the market has been expecting at least 1 or 2 still to come in 2024. And then, of course, we'll talk about the geopolitical events, and those are providing elevated risk at this time. So a quick review. Everything starts with supply and demand. And so here we're looking at the Lowry Supply and Demand Index, and we can see that the buying power is black and the selling is red. So we can see that they're starting to converge, right? So through the quarter, it's been a strong quarter. It's been a good quarter. The buyers have been in control. But we do see that these are starting to converge, and so we'll continue to watch the dynamics of supply and demand. When we look at the S&P 500, it was a great quarter. What we're looking at here is the top leaders and the laggers in the S&P 500. So out of 506 companies, 386 companies were up with 120 down. The index had a little bit over a 10% return, and we'll notice that the majority of that return, so almost 25% of the return, came from one name, and that was NVIDIA, okay? And so 25% of the return came from NVIDIA, and that's a lot from one stock. And so there's a little bit of distortion in looking at returns, because there's been really good portfolios that if you don't have a large weighting to NVIDIA, you underperformed. That's okay, it's temporary. NVIDIA is as good as a company as it is, and its performance has been great in the recent past. We would never want to build a portfolio or really rely on one stock. So NVIDIA has really been the story for the quarter. And then on the negative side, Tesla's been the equal and opposite reaction to the market, right? So we have Tesla down about 29% for the quarter, which represents about 5% of the detractions of the return on the S&P 500. So all in all, a good quarter. Again, a lot of concentration, even more so than the prior quarters with NVIDIA, and the market's been living and dying by NVIDIA. Okay. So when we look at sectors, again, you'll see that the S&P 500 has kind of been in the middle of the pack out of the 11 sectors. You had communication services up almost 16% at 15.57. And then real estate is the only sector that was down for the quarter, and it was down 1.36. So what this shows me is that asset allocation or sector rotation can work, because we can pick through these sectors and try to find ones that work. And so that provides a good opportunity for active managers. If the S&P was at the top and everything was below it, then that indicates that we should be a little bit more passive in our management. So this is how we know how to ebb and flow, and gives us great insight to how we manage portfolios. Okay, recession. We've all been talking about a soft landing or recession for the last couple of years. Right now, based on consensus estimates, there's only a 35% chance that we have a recession. Now, that doesn't mean that we don't. That just means that the Bloomberg survey, when they go out to all the smart money and large institutional banks and economists, is that 35% believe that there's going to be a recession in the next 12 months. So how do we break that down? Well, Again, from watching these videos, you know that we like to look at the top chart up here, which is the ISM indexes, both manufacturing and services. And anything above that red line is expansionary, and anything below the red line is contractionary. And this is, again, where we are going. This is a survey. This is like looking out of the windshield of the economy. And so you'll notice that the manufacturer is starting to turn up and is just now barely above 50. Services is still above 50. So we're not out of the woods yet, but we like to see both of these above 50. And you can see that they're converging right there. This middle panel, this is like looking out of the rear view mirror. This is where we've been. And this economic data point is GDP, right? Gross domestic product. And so this is all been positive, except way back there in 2022. So looking through the rear view mirror, the economy has been strong and resilient. And looking through the windshield, the economy is looking pretty good at the moment. So on the bottom chart, again, how do we get there? We're looking at the rate cycle. Again, the rate cycle here is in this orange line, and this white line is the S&P 500. And so again, in general, as rates go up, markets typically go down. If the Fed pauses or expects to go down, then that's a positive for the market. So the Fed has paused, and they're just going to be waiting to see if they can continue to pause. Maybe they need to lower rates, or maybe they're going to have to raise rates. So they're kind of in a wait and see, data dependent mode. And so we continue to watch the data as well. Okay, what drives the market? Well, we talked about this slide earlier, so I'm going to move on. We're going to walk through each one of these 5 factors. Now we'll walk through inflation, interest rate, corporate earnings, the Fed, geopolitical events. So here we can see inflation. On the orange line, this is the PCE, annual inflation rate. This is what the Fed likes to look at. It's their favorite measurement of inflation. And then the white line is the University of Michigan's 5 to 10-year inflation outlook. And so you'll see that PCE is now about 2.5%. The Michigan survey says it's about 3%. So inflation, as you can see, has really been coming down, right? And so when inflation comes down, that has a positive effect on stocks. Stocks usually go up when inflation comes down, and vice versa. Okay, so inflation is looking good. You can see a little bit of a tick sideways here, and the Fed and the rest of the world's hoping that this kind of flattens off here, maybe converges to this 2% target of the Fed. We're really hoping that this orange line does not start to go back up. Okay, if that orange line starts to go back up, then we can expect the stocks to go down. When we look at the 10-year interest rate, right, we've seen a flight to quality on the bonds. And so, again, we have this inverse relationship. When rates go down, stocks go up. And recently, we can see that rates have been going up a little bit here, okay? And that's why the market's had a recent pullback. Now, it hasn't been pulled back for the year. It's still positive for the year, still positive for the quarter. But over the last several weeks, the market has been pulling back. And this is one of the factors that might be causing that pullback, right? There's an opposite reaction. When rates go up, stocks go down. When rates go down, stocks go up. The next thing we'll look at is corporate earnings. This is really the major fuel of the engine, right? As earnings of a company, the cash flow. Right now, the consensus estimate on the S&P 500 is over the last 12 months, not estimates, the last 12 months, it's been $223 per share. The forward-looking forecast is 241, and so going from 223 to 241 is about an 8% growth rate. And then we've seen other work, and we have other data that said the growth rate could be as high as 11% on S&P 500 earnings. So again, if earnings go up, stocks go up. If earnings go down, stocks go down. So there's a direct relationship here with earnings, where when we have interest rates, we have that inverse relationship. Okay, so what this orange line is here is this is the forecast for the next 12 months. So you can see we end up at about 243, almost 244 per share. Going a year out, we look at about 275. And then a year out from there, we look at earnings to be about 298. So these are the forecasts. So in general, those are good. There can be hiccups along the way, and it's not a linear line straight up. But overall, the earnings have been resilient, and the consensus estimates based on all the forecasters on Bloomberg is showing that earnings are looking to be strong and continue to go up, and that should bode well for stocks. If earnings go down, why would they? If we do hit a recession and earnings do go down, guess what? We're going to expect stocks to go down. So when we kind of take the culmination of all that, what does that mean? Well, it means, again, based on consensus estimate, with the market being about 50.66 currently, and a 12-month forecast being 57.02, that means that the estimated return is about 12.5% on the S&P 500. Okay, what about the Fed? The Fed's paused, but expected to lower rates in 2024. Again, the relationship here is rates come down, stocks go up, and vice versa. If rates go up, stocks will go down. So you can see here from the famous dot plot, which we don't put a lot of stock in, but it is important. It is what the Fed is communicating to us, so we do need to pay attention to it. And so here we can see that the yellow dots are the median votes from the voting members. And we can see that, the general trend is down. And so that, again, would be good for stocks. As we talked about earlier, if they have to raise, that will not be good for stocks. Okay, but the rates are looking pretty good. So the last thing we have to look at are the geopolitical risk, and they still remain high. And so we have the Iran versus Israel conflict. That's a negative situation, although it's turned out a lot better than it could have been. Last Friday, the markets were definitely worried about it. Saturday, the attack happened. It was somewhat measured. So Sunday, the futures markets were happy. But then again, we're still waiting to see how Israel responds. And so it's, if they respond with more force, we would expect markets to have more volatility. If they have more measured or no response, then we would expect lower volatility and so forth. Ukraine and Russia is continuing, and the same thing there. The more volatility and uncertainty in the wars, the more the market discounts that. It puts a downward pressure. China versus Taiwan, again, that's still playing out. We still have a couple, 2 or 3 years, according to the political experts, on what might happen there. And so that's still an event that's lingering out there. A positive geopolitical event is the U.S. elections. I know that's kind of an oxymoron to say positive and U.S. elections in the same sentence. But, from the work that we've done and we've presented earlier in the year, typically election years are positive years for the market. And so, again, that geopolitical event typically is a positive factor for the market. So again, the geopolitical events is very hard to model. And so the most important thing we can do, the best solution for those of you who are worried about geopolitical events, is to make sure that you have a great understanding of how to integrate your financial plan with your investment plan. Remember, we go back to those 3 sleeves, the ABCs, right? How much protection money, 10% is kind of in the cash and the CDs and T-bills, and the 45% can be in structured product and annuities and things with caps and floors. And then here, as an example, C is the stocks and bonds. So again, this is just an example. This is not what we're recommending. So please understand that this 10, 45, 45 is not what we're recommending. You need to sit down, and these numbers need to be your numbers through your lifestyle return benchmark, right? And so these are just for illustrative purposes only, to illustrate that the best way to handle geopolitical risks are really to integrate your financial plan with your investment plan, right? You want to have your parachute before you get on the plane. Okay, so what's our outlook? Well, again, we're still pretty cautiously optimistic. The market's been good, and so we like that. But there's still uncertainty, as we revealed today. And so we're kind of neutral across U.S. equities, international, emerging market, fixed income, and real estate. There is kind of a bull waiting to happen in the cycle. And so we're hoping that the bull continues and we don't turn into a bear, but we just have to wait and see. So, in 2024, there's still a battle between risk on and risk off positioning. So a lot of investors are have long time horizons. They're like, what? I'm going to be fine in equities the next 3, 5, 10 years. So they're not worried about the next 3 to 6 months. Then there's other investors who are more concerned with the next 3, 4, 5 months. And so they're going to take on more of a risk off posturing. Okay. There's not a right or wrong. There's a right for you, and we can help you determine that. So again, the way you review that is looking at your IPS and your timetable and your other factors in your IPS. Those are the blueprints to your success. Okay. Again, don't fight the Fed is a famous saying. It's paused. The market's expecting rate cuts. If they don't, the market will have a small hiccup. Okay. Recession. We saw there's a very low probability of it. However, the yield curve is still inverted. Okay. Leading economic indicators are still negative. And so maybe a recession can still emerge. There's still a chance that happens. Okay. So as we've shown, there's an increased opportunity for active tactical management, both asset allocation and as well as the stock selection. But we have to be patient. Again, buying and holding these equities has been one of the better strategies this year, as opposed to trying to trade them too much. And so patience is important right now. And again, also remember negative compounding. remember that what goes down 10% has to go up over 11% to break even. And so from our writings earlier in the year, remember that 2022 was a down year, 2023 was an up year. And you would have been better to have been in cash or asset allocation strategies than being in the market. And so there's a lot of people that are in allocation strategies that are getting 5.5% return, which is the expected return, which is great for allocation. And they look at the market at 8%, 10%, 6%, and they feel like asset allocation isn't good for them. Well, that's not necessarily the case. You have to look at the whole time horizon. You have to look at the up years and the down years. Asset allocation isn't going to look as good in the up years as it will look in the down years. So it's more of a risk off tool. And so again, that's why having a good balance between your risk off and risk on tools is so important. Okay. Corporate earnings have been very resilient. We've discussed that. So we're just still watching, margins, and we'll continue to watch how the earnings materialize. And then geopolitical events are still a big factor, but they're really hard to model and measure. And so again, I can't adjust the portfolios for every geopolitical event that happens. That's why we need that great integration with your financial plan and your investment policy statement, your lifestyle return benchmark, and going through a fiduciary double check process in your planning. So what do you do? What do I do? Well, hold enough cash to make you comfortable. Evaluate your time horizon and your other factors, your investment policy statement. Communicate those changes. A lot of time people tolerance for risk changes and they forget to tell us. Well, please communicate with us because we can reallocate. In my example, maybe instead of going from 10, 45, 45, maybe you wanted to go 30, 30, 30, or maybe you needed to be, 100, 0, 0. So there will be a right allocation for your lifestyle return benchmark in your fiduciary double check, but you have to communicate with us as your life changes. And then you have to be patient. What are we going to do on our side? Well, we're going to listen to you is the most important thing that we can do. We need to listen to you and then adjust your ABC allocations as necessary. And so again, your job is to communicate what's going on, and then it's our job to take those conversations, your goals, your dreams, your aspirations, your wealth vision, and help you determine the right allocation of your investments. And then we're going to continue to manage cautiously. We're going to monitor and adjust, and we're going to continue to communicate. And so that's what we're going to do to help you get through this year. So with that, I'd like to thank you so much. I'm proud of myself here. I think I got this almost done within 30 minutes. So thank you for taking 30 minutes out of your day to learn about what we're doing and updating you on the markets and our thoughts. If you have any questions, please, of course, give us a call. Please read the written quarterly articles that we put out. We have an accompanying piece to this video for the quarter end report. So please watch that. Continue to watch Kelly's weekly videos. And again, if with any questions or concerns or changes, just let us know, and we're happy to make adjustments. So with that, I'd like to thank you once again. My name is Joe Mass, and we just really thank you for the pleasure of serving you. Have a great day.
The information you have heard is the view of Synergy Asset Management as of the date of publication. These views and opinions are subject to change without notice. Investors should not act on any recommendation, express or implied, or information in this material without obtaining specific advice from their financial advisors and should not rely on information herein as the primary basis for their investment decisions. Information contained herein is based on data obtained from publicly recognized sources and is believed to be reliable and is not expected to be updated after initial publication. This information has not been independently verified, and Synergy makes no representations or warranties as to its accuracy. The material has been prepared solely for informational, educational, and market commentary purposes and is not a solicitation of advisory services or an offer to buy or sell any security or to participate in any trading strategy.